Welcome to Real Estate with Brenda K, the show where we talk about anything and everything to do with your real estate. Today, we're talking about one of the most important parts of buying a home, and that's your financing. I'm joined today with a mortgage broker who helps buyers find the right mortgage for their situation. We're breaking down what brokers do, how they differ from banks, and what buyers need to know before moving forward. So let's dive in. Cyrus, thank you so much for joining us here on Real Estate with Brenda K.
Thank you, Brenda.
Today we're talking about mortgage brokers. So tell us a little bit about you and your company.
Yeah, so we're mortgage brokers. So our company is our brokerage is Premier Mortgage Center. So our company is myself, my two business partners, Scott and Igor. We're Premier Private Client Group. So we're a team underneath our brokerage, and it's us three along with three other brokers and our client care coordinator and our compliance officer and whatnot. But essentially our role as mortgage brokers as a team, essentially, is how we're set up.
So help us understand the difference between a mortgage broker and a mortgage specialist at a bank.
Yeah, so the big difference is we just have so many different options and choices we can work through. So on our side, it's the banks just have their product. All they know is what they can offer. They don't have access to the other banks and lenders. When we look at it, we kind of have a bird's eye view of everybody's situation or all what the different offerings are with banks and lenders, because not everybody's situation fits with the same bank. And every time you go to finance something, sometimes it's a little bit different. So sometimes Scotiabank is better, or BMO might be better, or TD might be better. What we can do is look at it from a broader scope and basically understand where you're going to fit best. That comes with mortgage product. It also comes with rates and options, right? So we can look at everything and say, this is the best the best setup for your scenario, and this is why, but it's only because we can see everything else that
you have that great big pot to pick from.
Exactly.
You use the term banks and lenders. So when you use the term lenders, who do you mean if it's not a bank?
So there's your major banks, so your Scotiabank, TD Bank, RBC, BMO, CIBC, Manulife Bank. A bank is essentially would be an institution that does mortgages, but also does credit lines and banking.
Right, like a regular bank.
Exactly.
Okay.
Then you have your lenders, we call them monoline lenders, your mortgage-only lenders. These are still Class A lenders, but they only do mortgages. So they only have mortgage products. They don't have credit cards. They don't have bank accounts, but they only do mortgages.
Good way to explain it. So like National Trust.
First National would be one. RFA would be another one. MCAP would be one. So these are all AAA lenders, but they only specialize in the mortgage space.
Okay, all right. And I know you can do Scotiabank. I know you can do TD.
Yep.
You can't do RBC, can you?
RBC and CIBC on the residential side are the only two banks we don't work with.
Okay.
We do have BMO now, so that's pretty big.
I didn't know that.
Yeah, over the last year and a half. So BMO's been a big addition for us. So that's been great to have them. And then every other bank and lender. And we can do RBC and CIBC on the commercial side, but residential is all the other ones.
So, many years ago when I first got into real estate, even with realtors, there was this misconception that, you always went to the bank. And then if you had a really hard file or hard to finance person, you'd go to a broker.
Yeah.
Which is not the case because, you do a lot of business with my clients. You do a great job with them.
Yeah, I appreciate it.
But that misconception has changed because even the amount of brokerage companies, Cyrus.
It's a lot of them. There's
a lot. Oh my
lot.
God, they're popping up every day.
Yeah. And the majority of mortgages now are done through brokers.
Right.
So Scotiabank, the majority of their mortgages are done through brokers. It's just the banks, and that's why BMO would have came back in the broker space. They want a bigger portion of that share. We're not dealing with, the majority of our clients are AAA clients that the banks want to have.
Right.
So they want a piece of that pie. You're not going to a broker anymore just because you need private lending or you're hard to finance.
That's exactly what it used to be.
Exactly. You're going for the experience and the choices now, essentially.
Yeah,
right?
exactly. The other thing too, Cyrus, I think you have to watch is that you have a good background, you have a financial background, you've been at this a long time. There are a lot of new brokers.
Yeah.
Right? And it's like that old saying, everyone's great to work with till something goes wrong.
Yeah.
Right? And then you see what they're like. So I really encourage people to, how long have they been looking after, even in a bank, you can ask a person, how long they've been with a bank. But brokers Are you regulated at all by any body, any governing body?
Yeah, we're pretty heavy. We're very much so now than we were before. Many years ago, you didn't need a license to be a mortgage broker in Nova Scotia. So other provinces like Ontario and BC, they have really strict regulations. New Brunswick, Nova Scotia's finally stepped up to the table. We have to have certifications, license, training, all these different things to become a broker. And the reality too, it's that lawyers go to school for X amount of years to understand law, right? We're dealing with finances. It's not just being a salesperson or being a good communicator. You also have to understand finance. It's very important, right? So you're dealing with interest rates, numbers, you're dealing with large sums of money for clients that are probably making their biggest purchase they'll ever make. So
Absolutely.
You have to understand finances. It's not just we're getting into a role to sell a mortgage. It's understanding how to put a plan together and how the numbers actually work, right?
And even where it comes from, like, because I didn't realize, and you were the one actually that taught me, is like, what drives and we can share this with the viewers, what part of the economy drives the variable rates?
Yeah, so that would be Bank of Canada essentially will decide the overnight rates. The banks will adjust their prime rates in relation to that. So if Bank of Canada raises their rates by 0.25%, typically the prime rates will raise by 0.25%, which then affects your variable mortgages, whether it's your payment or your interest rate, both. But some banks, they don't adjust the payment. They just change how much your principal and interest is. So Bank Canada, big driver of variable mortgages. Okay. Bank of Canada is not a direct relation of fixed rates.
Okay, so that's bond yields, right?
Those are bond yields.
Okay, I'm gonna let you explain.
Those are bond yields. So those are Canada bonds. So when you see the Bank Canada raise or lower their rates, the first thing we do is get clients call us and say, hey, does that mean my fixed rate's going down by 0.25%?
Yeah.
It's not. In some cases, it might not change. In some cases, fixed rates might go up. So bond yields are independent from Bank Canada. They're all related on the same triggers or aspects that affect the rates in general. But if Bank Canada changes by 0.25%, it doesn't mean your fixed rate's going to change. Yeah. And a lot of times your fixed rates will actually go down in advance of Bank Canada because they anticipate what's going to happen with policy rates and whatnot.
Right, with the bond yields.
Yeah.
Where do you see the interest rates going, Cyrus? Like, my prediction video last year was pretty good.
Yeah.
This year, little bit off. But because I thought and when I'm talking about conventional, right? I thought conventionals would be down to 4% by now.
Yeah. Yeah. And they are in some cases. Like we are seeing 399, 405.
On conventional or insured?
On conventional. Insured, we're even seeing a little bit lower.
Oh, really?
But it's been up and down all year. So, and when you're looking at what the banks think is going to happen throughout the year, you have a lot of the big banks think that Bank Canada might start raising rates toward the end of the year, right? So we're trying to manage it because every other day it feels like it's changing. It feels like there's new information that comes out, which is then changing the predictions of the banks. But for the most part, I think we're going to hold steady. And then I think there could be an increase towards the end of the year. It's hard to say, but I just don't see them going down much further than where they are now, right? Fixed rates have been the same for almost a year and a half now is what it feels like.
Just staying that way.
Yeah.
And, another thing I want to talk about, because you and I talked about it earlier, people can go to brokers, like say you've been with the bank for umpteen years. You can, when your renewal's up, you do renewals. You don't just do new mortgages. Yeah,
we do purchases, refinances, renewals. So if you're coming up for renewal, just get a second opinion. Maybe your bank is going to give the best rate, but it doesn't hurt to have a 5-minute conversation to actually make sure that's what's going to happen.
Right.
And then we'll take the time just to look at it and say, no, what they offered you is good. Yeah. Because we do that a lot. Sometimes clients call us and we're like, hey, you have a good offer, right? Can we do better? If we can, let's look at moving it. If we can't, just renew back with your bank if that's the right option.
Yeah,
right?
Exactly. Well, we were talking a little while ago because what you're seeing now happened to us last year. So we bought a secondary property in 2021 at 1.69%. And, we had to renew it. We had a 4-year term. And we had to renew last year at over 5. So our payment jumped up $420.
Yeah.
Now, what are you seeing in renewals that people in 2021, 2022?
Yeah, this is an interesting year because we're seeing all those 5-year fixed rates come up for renewal back in 2021. Those were your 1.5%, 2%.
Oh my God, it was insane.
Incredible rates. Money was basically free is what it felt like.
Yeah.
But then you're also seeing a lot of, because the 3-year fixed rates became extremely popular in 2023 when the rates were high.
I didn't know that.
Yeah, so
Okay.
that's been, and 3-year fixed rates have been the majority of fixed rates we've been doing the last few years anyway. People like it. It's shorter term. The rates are better on 3 years than they have been on 5 years. So that's been interesting too. But this year you have all those 3 years from 2023 coming due for renewal. So those people are higher rates. They're going to go to lower rates. But then you have all the rates from 2021 coming due, and those are all lower rates, not going to higher rates.
Oh, they're going to get a big surprise.
So there's on one hand, it's payment relief because you're going to a lower rate.
Yeah.
On the other hand, it's a payment increase. But the people who bought in 2021, that was the beginning of the crazy market increases and whatnot.
Yeah.
So they have a lot of equity in their homes. So there's a lot of ways to mitigate their payment increases.
Really?
Whether it's redoing their mortgage over a longer period of time.
Okay.
Whether it's consolidating some debt if they have anything that's kind of dragging down their monthly cash flow.
Yeah.
So the 2021s, in general, as an economy for mortgages, I think we're still in a good spot because tons of equity in the homes that are coming due for renewal. And the ones from 2023, if they could afford the payment in 23, they can definitely afford it now.
Yeah, it'll be
It's
lower.
Right? So
I'd almost think keep my payment the same and pay my house off sooner.
that's what we hope most people end up
Yeah.
doing. And that's what we try to get, increase
Yeah.
your payment. If you're used to paying $1,500 a month,
Just
don't
keep-
just take the savings.
Yeah.
If you can afford it, stay at $1,500 a month and make the
Yeah.
extra few $100 to principal,
Yeah.
right?
You said something really interesting there a minute ago about, combine things. So when you buy a house, the only thing you can build into the mortgage would be purchase plus improvements, right?
Yeah.
So, but you just mentioned when you renew or refinance, you can actually blend in things like truck debt,
Sure.
find it like,
Yeah. Yeah. Whatever you want. It could be, at that point, the equity is yours to use as long as you qualify to pull it out based on your income, right?
Okay.
So if you wanted to take some cash out to do renovations, if you wanted to take some cash out to knock out some line of credits or credit cards or car payments, because car payments are obviously quite higher now than they were
Yeah.
back in the day when cars were cheaper. But and also a good time to maybe roll that car payment into your mortgage to get the car at a lower rate.
Yeah.
We do that a lot for clients where
Yeah.
some banks allow us to do multiple mortgages under the same house. So all we do is we keep your mortgage the way it is. We take your car loan, put it under the mortgage at 4%. We still pay it off in 3-4 years.
Right.
But that also helps
now
your
it's into
payment
your
come
mortgage.
down.
Yeah.
So there's ways to mitigate,
Yeah.
right?
And the bank, the way you say it kind of paints a clear picture because when you first buy a home, you don't really have any equity in it.
That's right.
The bank wants to make sure if you need to sell it, they're going to get their money.
Yeah.
But now with the equity, people have been going up, and especially because me, I'm a stat girl every Monday, once a month. And, we saw increases in appreciation, 21 to 22, it was like 21%.
Yeah.
It was insane.
Yeah.
The market couldn't, but we're still holding steady at about 4 or 5, last month we dipped.
Yeah.
I think it was just the average sales
January.
there.
And
Yeah. So what do you think, Cyrus? Rate's not everything, is it?
No, and honestly, rate's important, right? But it doesn't mean anything if the mortgage is going to cost you more money at the end of the day, right? Meaning
In which
there's
ways?
Higher penalties, restrictions. Like some banks, maybe they give you a bit of a better rate, but then you're limited on how fast you can pay off that mortgage,
Okay.
right? Where you might go to another bank and the rate just might be slightly higher and you have all the privileges of making the extra payments.
Mm-hmm.
So all of a sudden you're in a position where you can knock that mortgage down multiple times throughout the year at a much quicker rate rather than being stuck to only making a payment maybe once a year, right? So having the flexibility in the mortgage is huge. Having a mortgage that is portable, having a mortgage that's easy to access equity if you need to. So sometimes you get clients who are too focused on the rate, they end up signing something that is too restrictive, and then it just ends up costing them more money down the road because they need to do something with the mortgage or they can't pay it off as quick or whatever it might be, right?
And I always tell people, as you know, when I send anyone to you, I'm like, ask Cyrus what the payment is, right? Instead of just the number itself. Talk about different other lenders. What's a good credit score to buy a house? What do you want your credit score at?
Credit score is a little bit of a loaded question because it's credit profile as well, right?
Mm-hmm.
So maybe you have someone who's had great credit, never missed a payment, but some of their credit cards are maxed out. And that's driving their score down. into the low sixes or the mid sixes. Or you have someone who has a 700 credit score, but they've only had credit for maybe 2 years for one trade line, right? The banks will look at the profile as a whole. And a lot of times, if you can justify why that score is a little bit lower, the bank would be more on board with someone with 20 years of credit history who's never missed a payment versus someone who has a higher score that's only had credit for a year or two.
Right.
So credit score on average, 680. Can you get a mortgage with as low as 600? You can.
Okay.
Once you get in the sevens, good credit, great credit. Once you start getting 750, 800, anything 800 plus, it's bragging rights at that point. Could be 800, could be 850. Doesn't change your rate, doesn't change how much you qualify for, but it's more so getting the credit score to a point where the bank it's acceptable to the bank, but also having the profile on the back end to back it up.
Okay, so if somebody is young, they haven't bought a home yet, and you'd say to them, what is the best way to build up your credit score so that you can get financing for your house?
Yeah, credit cards are a huge portion of a credit bureau. Yeah. So having a credit card, because if you have a loan, the payment comes out every single month, and as long as you make the payment, that's fine. But a credit card is really up to you. So it's how are you going to manage that credit that they've given you? So getting a credit card is the most important. As soon as you're old enough, get a credit card, and then just start using it, but don't exceed the utilization. Don't go over 50%. Okay. Another really important thing to keep in mind is credit card companies only report to the bureaus once a month on your statement date.
Okay.
If your limit is $5,000, and let's say you're like, hey, I pay my credit card every single month, right? That's great. But if it's reporting to the statement date that it's maxed out and you pay it off the next day, on the bureau, it looks like it's maxed out.
Oh,
it's hurting your credit score. So use your credit cards, keep them below 50%, and pay them on time, and you'll be fine. But if you start racking them up and then letting them get to the limit, that's when it starts having quite a bit of impact on the score.
Yeah, because you and I both know, like a lot of people, even myself at times, we use credit cards because we didn't have the money.
And it's business too. Like sometimes you're just using it because you're maybe it's a trip, maybe it's business, whatever it might be. These things add up, but trying to keep it below the limit for sure is a huge bonus. Huge bonus.
So if they are coming in to see you for a mortgage, do they need to bring with them to properly? Because I know pre-qualification, you don't check credit. We've talked about that before. You want to do a full pre-approval. Yeah. What information does the average person have to bring to you?
It revolves around income is the biggest piece. So when we do mortgage pre-approvals, obviously down payment is a portion of it, right? Credit's a portion of it. In terms of documentation though, you really want to have your income documents on that pre-approval because you might, and it's not that you think your income is incorrect, but maybe you say, hey, I make $75,000 a year. Okay. Right. But that's 70 plus bonus, right? Or 60 plus bonus.
Right.
And the banks look at bonus differently than they do salary income, right? So it's bringing the right documents, whether it's T4s or pay stubs or employment letters. Those are typically the few that we look for. If you're self-employed, it's tax returns and notice of assessment.
I was going to say, because, and how long do you have to, 2 or 3 years if it used to be 3 years if you were self-employed.
Now it's 2.
Okay.
So 2.
Because we've always been self-employed. So I know we used to have,
2 years. And there are programs that if you're less than 2 years, that banks can do it as well. There's alternative finance, there's those kind of options. Yeah. But generally 2 years of self-employment, backed with tax returns, notice of assessments. Banks want to make sure your taxes are paid. That's the most important. Because if your taxes aren't paid, CRA can put a lien against the house. Yeah. And that's where banks have an issue with it. So having the taxes paid is very important.
And show that that is.
Yeah.
What do you think about the stress test now? Like, you know how, because you and I had a conversation a couple of weeks ago on the phone, where I could see when the interest rates were 1.89, 2.5, and they said, look, you should qualify at least under 5. But now how does it work, Cyrus? Like, are you qualifying people at over 6%?
No. Well, in some cases, yes. So it's interest rate plus, it's whatever rate you have plus 2% or 5.25. So whatever's going to be greater.
Okay.
So average mortgage rates, let's say 4%. Most people are qualifying at 6%. If your rate is going to be 3.79, then you're qualifying at 5.79. So the stress test is essentially set up to be, in most cases, 2% above the rate. Yeah. And they have adjusted the stress test kind of back in the day. It used to be like 4.64, then it was 4.94, then it was 5.25. So it changes based on where they think rates are going to go. Yeah. But on average, 2% above the rate you're going to get.
You don't think they're going to change that even with the rates going up?
I think because they have the 2% above the rate you're going to get, I think that gives them a good enough buffer to feel good about it.
That's what I think too. Like, I don't think it's a bad thing because
I don't think so
it
either.
gives you that, remember when they were, your mortgage rate, we were giving out mortgage rate, people were buying houses at 1.89, qualifying on 5.25. So, and we both saw this a lot. You'd say, oh, well, you're qualified that you could pay $1,500, but your mortgage is only $700. And I used to say to people, take that difference and stuff it away because there will be a day they go back up. Then when they went back up, what did we hear? Oh my God, because they took that extra money and bought a motorcycle or a boat or a cottage. It was crazy.
Yeah, you always have to plan for the rainy day.
Yeah.
And essentially when you're looking at, like you hit the nail on the head, it's exactly what it is. At some point, rates will go up. At some point, rates will come down. You don't know when you in your mortgage cycle, your renewal's coming up, where you're going to be in that rate cycle. You have to plan for worst case scenario, right?
And people say about, listen, don't get me wrong, I agree. House prices are crazy. They really are. And they were saying, oh, years ago, you could buy a house. Like, we bought a brand new home in Kobe Village in 1987 for $85,000.
Yeah.
At 16% interest.
Yep.
So it was relative. Yes, the house was less, but we were paying 16% interest.
Yeah.
And the boomers all remember those days.
Yep.
It took, because I did some research, I knew you were coming on, from 1973 to 1990 for interest rates in Canada to go below 10%.
Yeah. So that's, I mean, it's crazy when you look at the numbers for sure.
Yeah.
And you see what those rates were versus what they are now. And then obviously in relation with the prices and stuff are now. But
Insane. So Cyrus, if we just to end it off here today, because I'll have you back on next season, we could sit here and talk for hours about financing. What would be one piece of advice if somebody's trying to get ready to buy their first home? What would you be, like say down payment assistance, or where can they get the down payment? What's your advice to a person wanting to buy?
I would say the thing you want to do first is, and do it as early in the process as you can, meet with a broker or a specialist, mortgage broker, and get a game plan in place. Because don't come when you think you're ready, because then you might not be ready and it might take some time to get you there. The sooner that we start the conversation, the sooner you're going to be ready, or at least you have a really clear roadmap of what it's going to look like, so that when you are ready to buy a house, you're going to hit the ground running, right? So don't wait too long to get that process going. Do it sooner, talk to somebody, get that part of it, because a lot of times people are kind of flying blind, right? So if you talk with somebody and you understand how your income is going to be looked at, how your bonus, your commission, if you change your job, how are these things going to have an impact?
Where you're going to get your down payment from?
Where
There's so many rules around that.
Totally. How much you have to save up, how much you need for closing costs, right? So all these different things, if you can get a grasp on what that looks like ahead of time, you're going to set yourself up. Whether it's a year, 2 years, 3 years down the road, have a roadmap, have a game plan in place now, so that you're ready when the time comes.
Exactly. Well, Cyrus, I really appreciate you being here today. I love chatting with you about mortgages. We're going to, of course, run your name and number along the screen here, so our viewers, they can reach out, give you a call, and they've got any questions, they can, they get the right answers.
Yes, I'd love to help. I appreciate it.
All right.
Thanks
so much for being here. We'll see you next season.
Sure, definitely.
Okay. Sounds good.
Thanks.
That was so interesting. I could talk about financing all day, because it's not just about getting approved. It's about really understanding your options and choosing what works best for you in the long term. A good mortgage strategy can make a significant difference in your financial future, and having the right guidance matters. Thanks so much for joining us. We have run Cyrus's name and number down along the bottom. If you've got any questions, reach out to Cyrus. And remember, if you're thinking real estate in Halifax, think Brenda K. Cheers.